Hello, everyone. Thank you so much for joining me. My name is Fawad Razaqzada, market analyst at Think Markets. Today, I'll be presenting the live market analysis webinar, and I hope you will all learn something useful from us. So this webinar is mostly all about technical analysis of major currency pairs, indices, and commodities, but I will discuss briefly the fundamentals as well. As this webinar is called Live Market Analysis, please help us by writing comments or questions in the chat box, and I'll be more than happy to provide analysis on any particular market you are interested in. Before we proceed to the live charts, and we do have to go through the risk warning, so please take a few moments to read through this. I will help you by reading the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So for those of you who are new to this webinar, basically it happens every Tuesday, 11:30 London time. And as I mentioned, it will be mostly about technical analysis on the major currency pairs, gold, indices, and crude oil. But we do touch on fundamentals as well. In most cases, I will create if and then scenarios whereby if a particular level breaks, what is the next most likely outcome based on that breakdown, etc. You will see what I mean exactly when we share the live charts. Okay, so obviously there's a question and answer session, but as I mentioned, don't wait until the end of the webinar to ask your questions. So what's driving the markets at the moment? Well, investors are continuing to rotate into stocks that are more sensitive to economic growth after Moderna's vaccine trial update yesterday lifted global shares. And that added to the optimism surrounding the Pfizer and the BioNTech data we saw last Monday. The Dow Jones closed at a record high, but today the markets have started slightly on the back foot. So some people are taking profit, which makes sense after big gains. Also, there's the case of surging virus cases still, especially in the US now. The epicenter is moving to the US once again, and some states have announced fresh lockdowns there. So that remains a key short-term risk in terms of the risk assets. Okay. Another point I'd like to make is that yes, there is optimism over vaccine and whatnot, but remember that since March the markets have been surging higher, partly in response to, obviously it's been a lot to do with the stimulus, right? Central bank stimulus and government stimulus, but there's also a case of people pricing in an eventual production of a vaccine. Okay, so some of the vaccine optimism was already being priced in, is what I'm trying to say. So if the markets were to turn around and create a bearish reversal pattern, try not to fight it, because that could potentially prove to be a near-term or a medium-term top. Okay, so just be careful. Right now everyone's talking about vaccines and whatnot, but it's when the markets are overly optimistic or overly pessimistic that we often see highs and lows being formed in the market. So just bear that in mind. But right now, hopes that the pandemic will be over has raised hopes that there will be stronger demand for crude oil, commodity dollars, and emerging market currencies. This has been the main driver behind the markets from a macro point of view. But equally, haven assets like gold and Japanese yen have fallen out of favor because people have rotated into stocks that rely on economic growth and so on. In terms of economic data this week, here is the list. I'm not going to go through it. The most important macro decision, as far as I'm concerned, is on Thursday when the CBRT, that's the Turkish central bank, decides on monetary policy. I will tell you why that's important when we cover the Turkish Lira later on. Okay, but this is the whole list of the key data releases coming up this week. Normally, some of these data releases would be really important, but given the circumstances that we are in and the fact that the focus is on vaccine optimism and also the current coronavirus situation, not many people are focusing on macro data. So for that reason, there's little point in going through this. Now then, let's go through to the live charts, and I will begin by, actually there's a question and a couple of comments here. Why does Zoom ask to access the microphone? I think it asks you to access the microphone in case you are a presenter, which in your case you won't be. So don't worry about it. You can deny access to it. Can you provide technical analysis on the Germany 30 or the DAX index? Of course I can, Gilbert. I'll do that right away. I will start off with the FTSE and then we'll go to the do the DAX afterwards. So this is the daily chart of the UK 100 index, or the FTSE 100 CFD. Recently, you can see that the index has been surging higher, all to do with optimism over the vaccine, as I've been talking about. And the index created a higher high above this level right here at 6040. When it broke that level, it created a higher high. So with the index creating a higher high, the path of least resistance has been to the upside since then. Indeed, the market, the index went on to break through the 200-day moving average, as well as key resistance around 6,300, this level right here. As you can see, it was previously resistance, resistance, resistance. We broke above it, came back down, retested it, and held as support. So for as long as the FTSE remains above this level on a daily closing basis, the path of least resistance would be to the upside. Okay, so the path of least resistance would be to the upside for as long as we remain above 6,300 from a technical point of view. Why that level is important? Because it was previously resistance and we've broken and held above it. So if the index were to go back below it and close below it, I think that would invalidate the bullish bias, at least in the short term. So if we do close below that level on a daily basis, then that could open the way for a deeper correction. But ultimately inside a larger bullish formation. So the index could pull back potentially back to the 200-day moving average, or even this level here, the prior high at 6040 before potentially resuming its bullish trend. But we'll cross that bridge if and when we get there. For now, these levels, the levels in blue, are the most important levels to watch. So as I mentioned, 6,300 is key, and so far we're holding above it. The next level up is at 6339, or call that 6340, which is the head of this small hammer candle that was formed a couple of days ago on Friday. So that level was a short-term resistance level, broke through it on Monday. The index is now coming back down to retest that. So we could see a potential bounce off of that level later on today. Now, longer term, I have drawn a potential path for the FTSE, as you can see on the chart, as I zoom out. It's all to do with Fibonacci-based ratios, okay? So it doesn't obviously mean that the FTSE will get there, and you know, it could well just turn around and head lower. Who knows? But just to keep things objective, I have drawn a couple of Fibonacci ratios on the chart. And this right here is where the 78.6% Fibonacci retracement of the entire downswing from the pre-lockdown highs to the March lows come in. And that's where we also have the 161.8% extension of the most recent downswing from point B to point C. So in other words, if you draw your ABCD tool, so if you draw a line here and you replicate that and connect it to point C, it projects that the point D will come in around here somewhere, which happens to be around those Fibonacci extension levels. So that's the longer term kind of objective. As I mentioned, it may not get there, and the road to potentially getting there will not be in a straight line, but it's an objective nonetheless. So that's the outlook for the FTSE. It looks bullish, but obviously today the markets have started lower, and what I would like to see now is for the market to bounce off of this level at the 6,340-ish. Interesting question from one of you guys in the room. If you want to place an order below the low, how many points below should the order be placed? That's a very good question, and I think it shouldn't be too far below. It really depends on your trading style. So the way I would place it, to get short on a potential break below this this low here, the way I would do it would be, I wouldn't sell short this just as it falls down. What I normally do is I wait for a proper breakdown and then sell the rounded retest of the last low prior to the breakdown using a limit or market order. But if your question is if you're bullish and you're placing a long order right around current levels, where do you place your stop? I would say no more than 5 to 10 points or pips below that, below the most significant low. There are occasions where you'll get stopped out and the market quickly reverses, but it's better to be safe than sorry. So I would, the way I do it in my personal trading account is 5 points, 5 to 10 points below the most, below a level where if the market went through it, it would indicate that my analysis is not correct anymore. So for me, it's around 5 to 10 pips or points. I hope that answers your question. Can you do technical analysis on German DAX index? Sure. This is the DAX index, okay, the daily chart. I always look at the daily chart first, and then all the other time frames. So as you can see, the DAX index has been pushing higher along with other global indices, and over the last several days, it has been consolidating in a tightish range. Okay, when it consolidates in a tight range like this, usually, but not always, you'd see a bullish breakout, because the longer it spends in consolidation near a high, the more likely it is that it will break higher. Because if resistance was really strong, it shouldn't take it too long to break down. So the more time it is spent in consolidation near a resistance level, the more likely it will be that the index will break higher. So that's my view as things stand. I think it's going to break higher. We're going to go above the post-lockdown high of 13,462 and potentially head to a new all-time high after that. In terms of support and resistance, the shaded region here is important because this was the last kind of resistance level prior to the latest breakout. And ideally, we want to see, this is really good from a bullish point of view. You want to see a consolidation near the highs. So currently we are seeing a consolidation, but as I mentioned, the longer the consolidation holds near resistance, the more likely it will break to the upside. It is possible, however, that the index could go down a little bit from here. So it's possible that if we break through the trend line here, it's possible that we could drop to this level before potentially bouncing back. Okay, so this level, the reason I've highlighted it is because it kind of marks the high of the last resistance prior to the breakdown. We've had a big breakout from there, and the index has never retested this level, at least on a daily time frame, before continuing higher. It doesn't have to come back down to retest it, but if it does come back down, then that would be the level I would look for bullish setups to emerge. Also, if I zoom out a little bit, notice that the prior sell-off right here, this sell-off from this high to here ended at the 38.2% Fibonacci retracement. Now, the 38.2% Fibonacci is a shallow retracement compared to the 61.8 or 78.6, right? So what does this tell us? Well, it tells us that in the grander scheme of things, the bulls remained in control despite a sharp sell-off there. And that if and when we break through the zero level or the most recent high, because of the fact that the index staged a relatively shallow retracement, you should therefore expect the continuation to be more significant above this high compared to what would have been the case if the index had retraced all the way to the 61.8 or 78.6% retracement, right? So in other words, don't expect a false breakout scenario to happen above the post-lockdown high because of the fact that the index retraced to the shallow 38.2. So in other words, I expect the DAX to break above the post-lockdown high and go on to create a new record high, potentially towards the 161.8 of this downswing over time. Obviously, it's not going to go there in a straight line. It's going to take time, but eventually, I think it's going to head to new record levels in the weeks and months ahead. So that's my view on the German DAX index. Now then, I can't see any further questions on the indices. Let's move on to currency markets. Okay, so I'm going to start off by with the DAX and with the dollar index. Rather, dollar index has been going down. The reason the dollar index has been going down is because demand for safe haven dollar has been falling, especially against currencies which are more sensitive to changes in economic outlook. For example, the Australian dollar. Australian dollar and other commodity dollars are sensitive to changes in economic outlook of the global economy. Okay, so when demand rises for I don't know, whatever Australia produces, iron ore, for example, from China, then this tends to push up demand for the Australian dollars because China wants to buy more of Australian iron ore, etc., etc. So same with the Canadian dollar. Canada is a major oil producing nation, right? So when the economy recovers, people tend to drive more and travel more. Therefore, demand for crude oil and crude products increase. And so exports of crude oil and crude products from Canada and Norway and other oil producing nations rises. And that puts upward pressure on their currencies because people have to change their currencies to the Canadian dollar or the Norwegian krona in order to be able to buy crude oil from those nations. So commodity dollars have been rising sharply against the dollar, against the US dollar. But we've also seen the pound gain ground against the dollar because of optimism that there will be a breakthrough in Brexit talks, possibly as early as next week, according to Bloomberg. We've also seen emerging market currencies rise sharply. Again, similar to commodity dollars, emerging market currencies tend to rise when people's perception of global economy improves. So right now, everyone is expecting the global recovery to continue and accelerate in 2021 because of the vaccines. And so emerging market currencies have risen, as well as the commodity dollars. Now, how and where do you check the fundamentals is a question asked by one of our attendees in this webinar. That's a very good question, because some people don't know. Well, it's always important to be aware of the news. So some of the financial websites that I use to check the news is Bloomberg, as well as Financial Times. In terms of macroeconomic data, you can look at Forex Factory. It will have all the latest data releases there. But yeah, you do have to read a lot and watch the news to understand what's going on. Obviously, the best place to look for to get an idea of what's happening in the markets is on our own website, right? If you go to the market analysis section of Think Markets, we produce on a daily basis lots of market analysis reports, which contain lots of fundamental news in them and tell you exactly what you need to know. We produce a weekly week ahead preview. This is usually published on Fridays, providing you a preview of what's going to happen next week in terms of macro point of view. So this is really important if you want to keep up to date with the markets. But on a daily basis, we produce at least 1 or 2 reports every day. So yeah, that's where you could find lots of information from. Don't forget also on Twitter, you can if you create a tweet deck. If you go to TweetDeck, you can sort your Twitter list. So if you on Twitter, you have lots of followers, right? But sorting this information is really difficult because everyone posts everything. How do you sort good information from bad information? Like let's say there's some news happening that the Fed is making an interest rate decision. You don't want to see this at the time of the release of the Fed's decision. What you want to see is you want to have a list of analysts and other market participants that cover news as and when they happen. So with TweetDeck, you can create lists and add people to those lists and have them. I don't want to open this because, but anyway, I'll show you. You see, I've created a list of traders, news and analysis, and a few users as well. So when some news comes out, all the latest news is there for me. That's one way to do it. Yeah, there's lots of free ways. You don't have to pay for FT or for Bloomberg. You can find lots of information free from Twitter, as well as other sources. But in terms of macro data, Forex Factory is quite good. It will cover all the major data releases. As I mentioned, data releases right now, they don't play an important role because everyone's concerned about the current pandemic situation and optimism surrounding the vaccines. Would you trust Zoom reports? I don't know what Zoom reports are. Sorry. Anyway, let's move on with the analysis of the currency markets. So that's the dollar index. Okay, I'm going to start off by looking at the pound dollar. Now, in the previous webinar, we highlighted this level, saying that if that level breaks down, then it will be bearish. the index or the currency pair rather never broke below that level. I don't know how many of you guys were in the previous webinar. Instead, what happened is it held that level and it continued higher. And so the path of least resistance for the cable continues to remain to the upside until and unless the chart tells us otherwise. So this level right here, or around that level, we had seen lots of price action around previously. For example, here, and then when the cable broke through that level, came back down, it held that level before continuing higher. So from here, it looks very likely that the cable is going to head towards a new high for this year. So the high for this year comes in at just below the 135 handle at 134.83, and then we have the 2019 high, which comes in at 135.15. So it looks very likely to me that the cable is going to do something like this. And remember what I talked about consolidation near resistance on the DAX chart. This is a similar situation. You know, we if you look at the cable price action over the last several months, it has been in consolidation near the highs. Okay, it pulled back to the 38.2, but it didn't go below that 38.2 for retracement. It didn't, for example, go to the 61.8 or lower. So that to me was always a strong indication that the cable wants to go higher rather than lower. And if you read my previous reports on the pound, you'll find lots of them here. You'll see that I've always, or in most cases, I've produced bullish outlook on the cable rather than bearish. Not just because of technical reasons, but fundamentals as well. So right now, the path of least resistance is to the upside. At what point will this outlook change? Well, it's possible the cable might come back down to retest these broken levels and put some pressure on the bulls. But for as long as we don't create a lower low, the path of least resistance would still remain to the upside despite any short-term pullbacks. So the most recent low comes in right here. This level right here was the most recent significant low before the market made a new higher high above this high. So if the cable were to break through this level, at that point, the bullish outlook would become invalidated. So 128.54 is the line in the sand for me insofar as the bullish outlook is concerned for the cable. Does that make sense? Okay, so Zoom is CNN reporting on the markets. Right, I didn't know that. You know, do you trust CNN reporting on the markets? That's an interesting question. I think there's nothing wrong with getting useful information from CNN and Bloomberg and other financial journalists. They tend to be a little bit late on everything. They tell you what has happened rather than what is likely to happen, which is, you know, that's their job, right? They're reporting what's happened and what's driving the markets. Some of the CNN reports and CNBC and Bloomberg, they have they quote people like analysts, you know, in terms of what they expect the markets to do in the future. So some of those reports will contain some information that tell you what might happen in the future based on some macroeconomic reasons, based on the economic models or whatever those analysts are using to come up with those predictions. So I wouldn't say they're totally useless, but you have to be careful how you filter information from those sources, any sources really. You really have to be careful. Ultimately, you got to have a understanding of what is driving the markets long term, and you have to be able to ignore short-term noise and focus really on the main drivers of the markets. So right now, what's driving the markets are two things really. First, it's ongoing stimulus by central banks and governments, providing lots and lots of money in the financial markets, putting pressure on bond yields, and that's driving investors away from, safe haven bond markets and into racier equity markets. That's been the main reason behind the stock market rally for many years now. But more recently, it's all to do with optimism surrounding a vaccine. People are optimistic. They're seeing the light at the end of the tunnel, that the pandemic will soon be over and that the global economy will recover strongly. That's what the markets are expecting to happen. So they're pricing in that possibility as if it was happening right now. So that's where the focus is. That could change, something else, some other fundamental driver could come and completely reverse the ongoing bias. But right now, there's nothing contradicting that view, or nothing significant is contradicting that optimistic view. Yes, we are seeing increased numbers of deaths and lockdowns across the world because of the resurgent coronavirus cases, but people are looking past that, and they're looking into the first and second quarters of the next year. So yeah, it's really difficult to filter out bad information or fake news from good information. But I suppose if you spend a few years trading the markets, you will come to understand how to filter that information. Anyway, back to analyzing the markets. So that's my view on the cable. I think it's going to head higher and take out liquidity. What do I mean by liquidity? Liquidity is basically resting orders above or below market. So think about it like this. If you are short this market, where are your stop orders placed? Some, technical analysis books will teach you to place your stops above or below highs, right? So people who are short or people who have sold the cable, some of those guys will have placed their stop loss orders above this high, some above this high, and others above this high, right? So what I'm trying to say is is areas above these highs is where you have lots of stop orders resting. Similarly, you have stop orders resting below significant lows like this or this low here. Those areas are pools of liquidity, and the market's function is to move from one area of liquidity to the next area of liquidity. That's the most important thing. If you're going to learn something new from this webinar, it's this: that the market is a function of liquidity. It moves from one pool of liquidity to the next pool of liquidity. So with that in mind, areas such as this and this is where I think the cable is going to head to next, because people who are long this market, they want to take profit on their long positions, and those long orders will be filled by matching sell orders that would be resting above these highs. Make sense? So that's why I think the cable is going to head to above 135 in the coming days. Obviously, a lot depends on the macroeconomic point of view, but technically, that's where I think it's going to head to. Could I do euro dollar? Sure. Let's have a look at the euro dollar. So the euro dollar is inside, or was inside, this bearish channel or bull flag, depending on your time frame. Short-term traders would have seen this as a bearish flag, a bearish channel. Longer-term traders would have seen this as a bull flag, right? So a bull flag is when the market rallies, then consolidates, making interim lower lows and lower highs. But then when it breaks above the resistance trend of the bull flag, then the longer-term rally resumes. Okay, so that's the thinking behind a bull flag pattern. Right, so the euro dollar has broken out of this bull flag. It has held above the 21-day exponential moving average, and it formed a double bottom or a false break below the September low right here when it spiked below, but then quickly rejected and it went up. After that rejection was formed, it went on to make a higher high above this high. So it's making higher highs after forming a false break reversal right here. So the path of least resistance, like the cable, is to the upside for the euro dollar. And I think from here, is going to head to liquidity resting above the 120 psychological level. So this level here was where the previous high was made. And there will be lots of stop orders above that level from people who are short this market. Judging by price action, it looks like people who are short are in trouble rather than the bulls, right? So if we see a squeeze on the shorts, if we see a short squeeze rally, then the market will head to levels where the trapped sellers will have placed their stop orders, namely above this high. So from here, I think the euro dollar is heading to above 120. And like the cable situation, I will drop my view, my bullish view on this market in the event we create a distinct lower low. Right here. So this is my invalidation level, this level right here at 116-ish. Okay, so if you go below 116, that's it from a that's the end of the bullish trend as far as I would be concerned. So it's possible, therefore, that the euro may come back down and consolidate for a little while longer. And if it does that, technically, it would still be bullish, right? Because of what I've just said. But if and when it goes below 116, then at that point, it's no longer bullish. And if and when that happens, the next level down would be the 115 psychological level, followed by the 200-day moving average and these Fibonacci retracement levels. Now, I want to show you something really interesting on the euro dollar. I just remembered. It's this right here. In 2017, the euro dollar did this. So the euro dollar in 2017 rallied, came back down, consolidated for a while, and then it broke out before heading lower. Okay. What's happened in 2020 is the euro dollar has rallied, and then it spent lots of weeks in consolidation. Now it's beginning to look like it wants to push higher. So we may see a similar situation as in 2017 unfold on the euro dollar, because we've had the rally, we've had the consolidation, but if past price action is anything to go by, then we are yet to see this rally in the euro dollar, which could happen in the coming weeks. Notice also that the low that was hit in March was above the last low. that was hit in 2017. So here, the euro dollar made a higher low compared to this low. And what's more, if you draw a line here connecting this low, you can see that it had made in 2017 a false break reverse, a major false break reversal that ended the prior bearish trend. This was a multi-year bearish trend that ended right here when the euro made a false breakout attempt that didn't hold, and then the market went up to take out the previous highs right here. So there was a breakdown in the long-term market structure of lower lows and lower highs. So what happens then? The market comes back down, deep retracement, and then resumes its bullish trend that started in 2017. So the euro dollar, in other words, could be inside a long-term bullish trend. And that long-term bullish trend could potentially be about to resume. If so, we could see the euro not only break 120, but potentially go on to take out the 2018 high at 125.55 as well. So longer term, that's where the euro dollar may head to in the coming weeks and months. It's possible. Yes, the European Central Bank has said that they will increase QE in December, but that's priced in now. So how much of a negative impact that might have on the euro dollar remains to be seen. Obviously, the path to that level, it's not going to be a straight path. We may never get there. That's also obviously possible. So it's best to take it from one level to the next and then reassess the situation. So from where we are right now, the next level up is the liquidity above 120, as we saw on the daily chart. And then beyond that, we have 122.50, which is the base of the breakdown here, which has never been retested on the weekly time frame. So we may see some resistance there. And then if and when we get above that, then the next pool of liquidity would be above the 2018 high at 125.55. Okay, so that's the bullish scenario, long-term bullish scenario I'm looking at for on the euro dollar. We've talked about the pound, we've talked about the euro. Let's talk about the euro pound, shall we? The euro pound is consolidating or falling inside this bearish channel. Now, this is not a bull flag, okay? This is a bearish channel. Why is it a bearish channel? Because we've broken this low here, the most significant low. We broke it right here. So with the euro pound falling, this tells you that if you're bullish on the pound against the dollar and also bullish on the euro against the dollar, that you should be looking for bullish setups on the pound against the dollar rather than the euro against the dollar, because the cross is showing more strength for the pound rather than the euro. Equally, if you are bearish on the euro dollar and bearish on the pound dollar, you should be looking for bearish setups on the euro dollar rather than the pound dollar, because the cross, this pound euro pound, is telling you that the euro is the weaker of the two currencies. Make sense? So from here, where do we go in terms of the euro dollar, euro pound? Well, the first level of support or potential support is the high of this hammer candle or doji candle that was formed a few days ago, last week. That level remains exposed for a potential retest. We may get a bounce off of that level, but if that level breaks on a daily closing basis, then the next stop would be, well, God knows where, but the most likely scenario would be for the euro pound to then do something like this, right? So liquidity resting below these lows from trapped bulls is where the euro pound may then head towards once, if and when this level of support breaks first. In terms of invalidation, the most significant high is right here. That was the last high prior to price making a lower low. So in the future, if the euro pound were to break through that level, at that point, you'll have to drop your bearish view on the euro pound. Make sense? Now then, I did mention the Turkish Lira, and there was a reason behind it, because we've seen a major development happen in the Turkish Lira. If I show you the weekly chart first, the Turkish Lira has been falling for a number of years against the US dollar and other major currencies because of growing concerns about the Turkish economy. President Erdogan has been allowing inflation to rise rapidly because he doesn't like hiking interest rates to control inflation. So money has been pouring out of Turkey because of concerns about its finances and the economy. And not to mention the coronavirus situation, hurt the Turkish economy, which relies heavily on tourism, right? So with no one traveling for holidays and vacations, the Turkish lira has been falling rapidly. And that drop accelerated a couple of weeks ago when the Turkish lira hit a new record low against the US dollar. So the US dollar against the Turkish lira has been rising until last week. Last week, what happened is, this is what happened. We broke through this bullish trend line and we created a lower low. So this was the most recent low. We broke through that. The reason this happened is Erdogan, the Turkish president, he had a change of heart. After becoming under significant pressure from everyone in Turkey, he replaced the finance minister and the head of the central bank in an effort to bring down inflation in the economy. So Erdogan said he will support whatever decision the new leaders will make, meaning that he will no longer oppose higher interest rates. So now a speculation has grown that the Turkish central bank will hike interest rates significantly on Thursday. And then that could lead to an appreciation in the currency as investors slowly come back to come back to Turkey, hopes that interest rates will rise and that will tame inflation, and also as they look towards more normal times ahead with the vaccine, hopefully lifting confidence, allowing people to go on vacations in Turkey and elsewhere, boosting demand for the Turkish lira and other emerging market currencies. So that's the fundamental backdrop. So there is a potential, therefore, that given this macro drop and also the breakdown of this bullish trend line, and not to mention the fact that for the first time that the dollar Turkish lira has created a lower low, that there's a potential we could see a significant move down in this currency pair in the coming weeks and months. So it's definitely something to keep an eye on if you're looking for some exposure in emerging market currencies. Any further questions, guys? We have run out of time. This webinar was meant to be half an hour. We've gone over by 20 minutes at least. I have time for one or two more questions. Okay, Selena, CHF and gold. You know what? Let's just talk about gold, okay? I don't think I'll have enough time to cover the CHF against the Japanese yen. So let's talk about gold. Now, gold, this chart looks really messy. Let me just clear a few things. Okay, so gold had been in a strong bullish trend for a number of months, years even. More recently, we have seen the rally stall. Prices went into consolidation, and since then, so many times it looked like it was going to break out, for example, above this trend line, but then it failed. And it kind of continues to hold near the lows of this consolidation pattern. So as things stand right now, I am not very keen on gold. A, because of how price is struggling, and B, because of what's happening in terms of the macro picture. Investors are evidently, favoring racier equity markets and emerging market currencies over safe haven commodities like gold and silver and Japanese yen. So right now, I don't think it's the best of times to for investors to be looking at gold prices from a bullish point of view. Not to mention the fact that it's kind of overvalued at these levels because of how strongly it has already rallied in the preceding months. So right now, I'm not too keen on gold from a bullish point of view. Indeed, I think there's a possibility we could see a big drawdown, a big drop towards 1800 if these levels break. So a clean break below the August low could trigger a potential drop to 1800, which is which you can see on the weekly time frame that it was a key resistance in the past, which could now turn into support. So that level is the next level of potential support to look out for in the event price breaks through this area. So I would rather wait for this breakdown to happen than look for sell setups, because right now we don't have a clean break through this shaded region for bearish setups to emerge. What about bullish setups? Well, it's really difficult to be bullish on this market at current levels. Okay, so not least because price is testing and holding resistance around 1895 area, which was previously support and resistance, which you can see clearly on a hourly chart also. But from a daily point of view, we need to see a higher high. So if we go above this level here, this is last Monday's drop, right? So if we go above that, then at that point, it will look bullish again to me. But ahead of that level, you have lots of resistance levels coming in, for example, right here at 1935. But more importantly, right here where gold is testing right now, because that's where the trend line is also coming into play as well. So if it breaks through this first level of resistance at around 1895 on a daily closing basis, then it's possible that we may see gold go back towards the 2011 record high of 1920 and possibly 1935 in the short-term outlook. But longer term, I will not be bullish on gold until it breaks its most recent high at 1965. So that's the line in the sand for me. If I'm correct, the Swiss franc is considered as a financial haven like gold. Yes. Through fundamental analysis, we can easily understand that the Swiss franc will be weaker. But through technical analysis, what can we say regarding the Euro Swiss? Oh God. Okay, let's do that one as well. Then we'll wrap it up there. Where are you? So this is the daily chart of the Euro Swiss. As you correctly mentioned, the Swiss franc is deemed by market and market participants to be a haven currency. So with regards to that and the fact that the euro as a currency has been strengthening against the dollar, potentially we could see the euro Swiss rise in the coming weeks and months as demand for haven currency, for safe haven Swiss franc falls, and demand for euro, which is a more risk sensitive currency, rises. Not to mention, we have broken through this bearish trend line, or this one, depending on your view. So technically as well, the euro Swiss looks bullish to me. So yeah, it looks like prices inside this consolidation zone. If we break above this zone, it's gonna potentially continue higher to take out liquidity, resting above the next significant high, which was this high here at 108.77, followed by the next high here at 109.15. Key support comes in, in the event we break below this consolidation zone. The next level of support is this area here. The reason I have highlighted that area is because it was the last area of resistance prior to that big breakout we saw a few days ago. So in the event price breaks through this support, we could see something like this. Something like that is what might happen if this level breaks. Alternatively, if we break the resistance level here, then what you want to see is something like that. So in either cases, I think euro Swiss is going to go higher until and unless we see something bearish unfold. So for example, if this level breaks, at that point, I would drop my bullish view on this market, because this was the last low prior to the big breakout. So there's no reason for the market to come back all the way down to this level again. Anyway, thank you so much for joining me. I hope you've learned something new from this webinar. Join me again same time next week. And in the meantime, don't forget to follow us on Twitter for the latest breaking news. And make sure you read our regular market analysis reports that we post on the website. We've got a YouTube channel as well. I'm creating lots of technical analysis videos. Please share them. And I wish you all the best, and see you next week. Take care. Bye-bye.